Competition in biotech. One of the things that we say very often on this podcast is that economics is the theory of competitive response. And of course, this applies to our investments even more. We believe that the question of competitive response is at the core of wealth generation from an investor's perspective, even from an entrepreneur's perspective. We're facing competition in one of our stocks, which is Pacific Bioscience. And I want to discuss the concept using this case and also offer my ideas about how I feel about the competitive threat. Pacific Bioscience is threatened by Illumina. Pacific Bioscience is the leader in long-read gene sequencing, and Illumina is entering the market. And given that Illumina is much bigger, the market is pricing that in the stock of Pacific Bioscience, which is down, I would say, roughly 70% from its peak about a year ago. So it's not just, of course, the competitive situation, but I would say it's probably the main reason, and it also explains why we had such a lackluster performance in this stock, which is one of our most cherished stocks and best case studies for disruption. This is the Not Even Wrong podcast. It's January 13, 2022. This is Krim Telco. Since the last update, we're down 4%. The market's down 50 basis points. For the year, we are down 2.9%. The market's down 1.2%. We're underperforming by 1.7%. Let me start with the situation in the market. We have another sell-off in the market today. The volatility is very high. Regime change in the Fed, I think, is the main reason. Regime change in the Fed going from raising rates also to quantitative tightening, which is the idea that the Fed will start pulling liquidity out of the market. I've done some work on this in the last couple of days, and of course these things are very difficult to analyze because people are very tight-lipped. But there was actually an interview on the David Beckworth podcast, Macro Musings, with a person that is actually in charge of the New York Fed open market operations. And the lady said that this whole quantitative tightening is a very staged process where you first start not reinvesting your interest and not reinvesting the principal, and then maybe potentially also selling assets on the balance sheet of the Fed. Now, the question, of course, for the Fed is how do you tame inflation without causing a recession? And the art of doing that is very difficult. We believe that the chance that the Fed will miss is very high just because it's so difficult to do. So the chances of a recession now are much higher, and this is priced in our stocks, particularly in the growth stocks. Now, our growth stocks we are long fundamentally new concepts and engineering practices with large impact. So we're by definition are investing in disruptive companies and growth stocks. And we have had an underperformance in the biotech space, and year to date we are down 4% in the portfolio, which equates to almost, this is a 15% position. So for a 15% position to be down 4%, we have to be down almost in the mid-20s, about 30%, between 25 and 30%. So the index is down a lot year to date. We're taking massive hits in PacBio, in Intellia, Twist, Beam, and Caribou are a little bit less affected. Let's talk about Pacific Bioscience, which is the worst performer this year. So Pacific Bioscience is in the gene sequencing business, and it's a disruptor. It's a newcomer to the market. Illumina is the big gorilla. Illumina wanted to buy actually Pacific Bioscience a few years ago, and then the deal got blocked by antitrust. What happened is the following. Illumina has revolutionized genetic reading, gene sequencing, the reading of the genome. The cost of reading a genome went from $1 billion to $1,000. So the human genome, for example, can be read for, I think, something like $1,000. And this is primarily thanks to Illumina. Now, I would say that this whole gene sequencing business, of course, is very exciting, and it's a new field, and we're all very happy about it, but it is still definitely gene sequencing 1.0, because you have a lot of problems that you can't solve with the current gene sequencing methods. For example, the long read side of things. So what the long read side of things means that at one shot you can read longer periods of the DNA. The problem with that is, one is the reading, the other is also having long parts of DNA stable enough to be read. So there is a technical problem of even preparing the kinds of DNA that you want to read, and then of course the reading itself. Now, PacBio has enabled long reads. I don't want to go into too much detail, but the idea is that you have long reads which were useful but very expensive and not very accurate. And what PacBio did in the last 2 years is lower the cost and increase the accuracy. And that's why we believe that PacBio is the perfect example of a disruptor, because they're coming into a market with new products, with new concepts, new engineering practices that people haven't even known before. Illumina, of course, has seen that. That's why they wanted to buy them, and that's why antitrust said no, because antitrust, for the right reasons, believed that there will be a lot more competition between Illumina and PacBio, and this is exactly what happened. Because what PacBio did is not just offer people who want long reads a service, but also entering markets that traditionally were covered by Illumina. Now, there's two ways that this can go. Excuse me, before I go there, of course, Illumina, as a response, because they couldn't buy PacBio, has now decided to enter the business themselves. And they announced at the JP Morgan conference, and also a little bit before, but the JP Morgan conference, which is going on right now, one of the big news on the gene sequencing side is that Illumina is entering the long read business with a big splash, with big new products. And now, there are several ways this can go. One, it can become a race to the bottom, which means that you have a limited market where Illumina and PacBio basically slug it out, and because Illumina is bigger, they will win and PacBio will lose. The second, more likely scenario is that competition is good for both. It will increase innovation and increase the market share, the market size for both, because with the innovation, with the new solutions to new problems, demand will go up. Also, this is what we've seen in Silicon Valley with software, with cloud, with all these things. It is always such that new innovations don't just go after the existing market, they create new markets and new demand. This is most likely what's going to happen, and therefore we're pretty comfortable with the situation right now because we believe that the market is open for more demand on both sides. This is the way we see it. So therefore we believe that in the short term we will have of course a repositioning in the market by investors who fear that Illumina will go after PacBio. But in the long term, we believe that both of these companies will take huge advantage of the innovations that they can deliver on the long read side. We've, for example, seen already innovations in the, let's say, prenatal testing side of things, where we can do long read gene sequencing and read a lot more than just what was being read before with the short read. So you can gain a lot more knowledge, you can solve a lot more new problems, create new problems, solve problems, so create an innovation stack around this technology. And this is why I said in the prelude that PacBio was the most cherished position we have, because it's really a nice example of disruption. Doesn't necessarily mean that Illumina will suffer. We said that, and that we were wrong on that one, because when we were predicting that PacBio will get more market share, we were actually not taking into account the fact that Illumina will be also competing in that market. Now, having said that, of course, I want to discuss a little bit the competitive situation head to head. So what do we expect typically in situations like that? Now, again, this can go several ways. Typically, a disruptor like PacBio ends up winning in the marketplace. It's very difficult for incumbents, even if the incumbents are themselves disruptors or creators of new markets such as Illumina, it is very difficult for them to jump on that new bandwagon, which is, let's say in this case, the long read scenario. For example, we had situations like that in software. We had the cloud computing side with Amazon, and then Microsoft and Google, they were able to enter the cloud business, but they weren't able to stop Amazon from being extremely successful in the cloud business. We had Intel revolutionizing, of course, semiconductors, not able to answer to, let's say, innovations from the AMD side. And then another very interesting example of how innovation and incumbents interact with each other is Netflix. We had Netflix revolutionizing streaming, and then everybody else coming, let's say Disney and HBO and all these people. And again, we had actually for a while, there was a fear that Netflix will be stopped by these companies, but the reality is that Netflix cannot be stopped. Doesn't mean that the other companies will suffer, but in the end, actually, it is such that Netflix keeps gaining market share from the others. And then, of course, the mother of all examples is Tesla and the incumbents, which cannot compete with Tesla. So having said that, we believe that even in the same will happen here, that actually PacBio will end up winning in the marketplace. Illumina will grab share, so it could be a little bit like in the cloud business with Microsoft gaining share in a certain market and Amazon still dominating the market. But we don't think that Illumina will kill or destroy the growth prospects for PacBio. This is our view. It is very difficult to dissect what's going on. If you listen to what people are saying, let's say Illumina is of course saying we have new, better technology, we are much better than the legacy. PacBio is saying no, that's not true. We have solutions that they don't have. So it's kind of out in the open and very difficult to gauge who is right and who is wrong for us outsiders. I believe it's probably posturing on both sides, and the reality is who decides, or how do these types of games, let's call it a game, get decided. In the end, it's culture. And if you have the culture of innovation, you have a better chance to respond. So that's the good news on both sides so in the case of Illumina and PacBio, I would say there is a culture of innovation. Now, the other side, of course, is also technical know-how. So if you have PacBio, which was founded and built on top of the long-read sequencing business, it is very likely that PacBio will keep dominating that market. Again, it's very difficult for me to dissect now, reading public comments, 10Ks and all that, what really is going on, and I think I have to dive a little bit more into the technical details, and I will do that today and tomorrow. But I already have a sense from what I've read, particularly what was now published in the context of the JP Morgan conference, that both companies will claim that they have dominant market positions. So it's very difficult for us outsiders to really have a good sense for who might be a winner or a loser. And therefore, I believe the best way to go forward for us, the best analysis here is to assume that both companies will find markets in the long read space, and that they will be increasing the demand for long reads, create a lot more interesting problems and solutions and innovation stacks around their specific niches within the long read space. This is our working thesis right now. We could be wrong, of course, but we believe that particularly things like, let's say, liquid biopsies, testing in general, diagnostics, and then, of course, also the gene sequencing side of things for research purposes. There's so much new things that can be done with the long read technology that we believe that both companies will be able to take advantage. So to summarize, there's a competitive threat on the side of PacBio being threatened by Illumina, which is a new situation that we have to deal with, and I think it's a good lesson. The purpose of this podcast is to give people a sense for what it feels like to run a hedge fund. So this is a very good example of where you buy a stock assuming disruption, and then that company, which is the disruptor, all of a sudden is at risk of being disrupted themselves, or maybe not disrupted, but through competitive response at risk of having to deal with the incumbents who, of course, don't want to give up market share. And what we believe most likely will happen is that both companies will be able to increase the market and therefore maybe maintain their share but grow with the market. And this is the big question. How fast can this market grow? And the answer to that question is how fast, how much value can they deliver, how much innovation can they deliver, and the more innovation, the more value they can deliver, the more they will be able to expand the market. Because it's always the same in these types of situations. You have to deliver more for less, and then you will gain the market can grow. You don't necessarily have to gain market share. You can just deliver more for less. That means you can deliver solutions, new solutions that haven't even been there before, or you can deliver solutions that are a lot more cost effective than before. Therefore, we believe that both companies will win here and that PACBio will remain a very good investment. Thank you.